India is at a cusp of change. Fundamentally, our economy is strong. Macros continue to be robust. Global uncertainty hasn't impacted India in a manner that it has many developing countries and developed countries, as various brokerages, global banks and institutions have reiterated. 76 years since independence, India is primed to be the third largest economy in the world by the turn of the decade. Now, India has a long path to traverse, and to decode broader economic parameters and the growth journey for India is Sanjeev Sanyal, Principal Economic Advisor, Govt of India. Mr. Sanyal, thanks very much for taking time out, sir, this afternoon. I want to first begin by asking you, India is positioned and primed to be an emerging market leader. Various brokerages are saying so. A lot of surveys are saying so. How do you see India positioned by 2030? Since we're discussing India at 2030, I want to begin by asking, how do you see and where do you see India headed by the end of the decade, sir?
Well, I mean, we, as you yourself pointed out, we are already the fifth largest economy in the world in dollar terms, and in PPP terms, we are the third largest economy already. Now, the next two economies in that chain are Germany, so we are at about $3.8 trillion economy in the last financial year. So Germany is at about 4.3 trillion, and Japan is at about 4.9 trillion. And so we expect that we will probably go past Germany in about 18 months to 24 months' time. And then probably go past Japan around about 2028. So, the fact that we will surplus them suggests that we will, that from an arithmetic perspective is now more or less inevitable unless there is a major unexpected shock of some sort. But I would like to make a few caveats here that we will remain, in per capita terms, still a very poor country. So do remember that. Mm-hmm. And also that the number one and number two largest economies in the world are much, much larger. So the US is about $24 trillion economy, and Japan and China is about $19 trillion economy. So even when we go past Japan and become a $5 trillion economy, we'll still be long distance short of the top two. Nonetheless, it will be a big, landmark for us, in multiple ways. So that's a good thing. Right.
Yes, Krishna.
Right. I want to ask, as we celebrate, this Independence Day, and as the Prime Minister has often spoken and reiterated the Amrit Kal that we are in, that we are at the beginning of this Amrit Kal that we are in. Talk to us. You were talking about the per capita income. There is even estimates that that the per capita income figure could also see a rise as we hit the year 2030, and for us to become a proper middle income economy, so to speak. And that itself, sort of sets so many Indians and so many parts of India financially free in that sense.
No, there's no doubt that we are becoming a middle income country. There's no doubt that per capita incomes are also rising. So it's not like they're not rising, they're just that it's from very low levels. Nevertheless, even the levels that we have already seen have led to, as the Niti Aayog's recent report suggested, over 100 million people were pulled out of poverty in just the last few years. So that process will continue. Extreme poverty will drop sharply with, even as our per capita income hits somewhere in the 4,000 range. It will very, very significantly, maybe not entirely disappear, but it will become a very small proportion of the population. So in that sense, I would argue that by 2030, as our per capita income begins to hit levels where this very extreme form of deprivation becomes a thing of the past, we are the world's third largest economy, not just in PPP terms, but in proper nominal US dollar terms. Certainly our position in the world will be at a much higher place in every which way.
Mr. Sanyal, you mentioned an important figure of $4,000 per capita income by 2030. That, of course, is the prediction. How happy and satisfied are you with that figure, given, you yourself pointed at some of the caveats, which is the inequality in this country? While we've pulled 100 million people out of poverty, it still so appears that large volume of that money and that resource rests primarily with well-off people. So inequality seems to be...
That's actually not quite true. I mean,
Okay.
Of course, there is inequality in the country, but our real problem is not inequality, it's absolute poverty. And I think this diversion of attention to inequality unfortunately dilutes the real issue. The real issue is that a very large number of people in our country are poor in absolute terms, and the real attention should be to remove that absolute level of poverty. What happens is this, going into this inequality debate and Gini coefficients, etc. Yes, there is inequality, no doubt about it, and but the real problem is absolute poverty, and we have to focus on getting that down.
All right. Another concern for the government and for RBI continues to be inflation, which has been revised upward to 5.4% for financial year 24 from 5.1%. How important and significant a problem do you think inflation will be? A lot of people, of course, continue to talk about, especially these days, continue to talk about vegetable inflation, pulses inflation. How significant a challenge do you think inflation will be in weeks and months to come, sir?
Well, I agree with the RBI's assessment of the situation. I mean, inflation, right now, there is no underlying inflation, but the fact of the matter is we have this problem with spiky vegetable prices, something I wrote about in the 2022 economic survey as well. And the ultimate solution to that is to make changes in our farm policies. But that's a longer debate to be had. I mean, for the time being, until we have these cold chains developed and so on, we will have these spikes in vegetable prices. But in general, there is no underlying long-term pressure on inflation in this country. Inflation is in the 2 to 6% target range. And as far as I can tell, the sort of underlying core inflation, if anything, continues to be well behaved. Remember, wholesale prices are still in negative territory. So in that sense, that I don't think this is a sustained inflation problem. We do have a vegetable price spike problem, and this obviously the weather patterns and so on have an impact on that. And we do have a agricultural cold chain problem, which is something that we have been debating and discussing for a while.
Right. Also, I want to ask, as an economy, the predictions are that India is going to be anywhere between $6 trillion to now $10 trillion by the year 2030. I want to help us understand, like for us to reach that figure from here on, what are the factors that are going to prove crucial? And I want your own personal take on where does it lie? Is it $6 trillion or $10 trillion?
Well, I'm not in the game of trying to predict these numbers. As I said right at the beginning, we are somewhere around a little short of $4 trillion right now. By the end of this financial year, we will be probably a little bit above $4 trillion. And I think as I said, we'll probably go past Germany's $4.3 trillion in about 18 months or 24 months at most. And then we will go past Japan's 4.9. So we'll be about $5 trillion economy by 27-28 time frame. It's a little bit behind schedule from what we had originally wanted for a $5 trillion economy, but then we lost 2 years in the COVID episode. So so that we had to make up. So we will make it nonetheless to the $5 trillion economy by about 27-28. And then we will be somewhat higher than that, depending on what the growth rates and circumstances of that time are. Somewhere between 6 and 10. I mean, you could put a number yourself, depending on what your beliefs are about the global growth. I think one important thing people keep forgetting is that while India's own growth dynamic has dramatically improved in recent years, in the end, sustaining very high growth rates can only be done under circumstances where the global demand is strong. Because if we are just growing on our own basis, then remember, we will generate imports. And if the rest of the world is not growing, we can't export at the same pace. And so our current account will not be able to deal with this. So our current pace of somewhere in the 6.5%, 7% range is, I think, what we can sustain under the current weak global demand situation. Now, these things go in cycles, as you know. There will be a time when you will get global growth being more robust and global demand being more robust. Under those circumstances, India's growth can easily go up to 8% plus, maybe.
All right.
And, so then it's a question of what is the compounding that you see. The whole discussion we are happening really is about compounding.
Right.
And when you begin to compound a real growth rate of somewhere in the range of 8%, and remember, in nominal terms, that is over 10% because, depending on what you think inflation will be. So you're compounding it over in double digits. And that is basically what China does as well. It compounded in double digits over periods of time.
Mr. Sanyal, you briefly touched upon global economic scenario, a lot of uncertainty that continues to persist. A lot of it is not in India's control, as a result of which we've seen exports decline, but we've also seen imports decline. Net, the current account deficit has been narrowed in the month of May. Figures are still coming out for the month of June. How is the import-export scenario looking like to you, especially on the back of the fact that India has been pushing for Make in India, and as some would say, rather aggressively?
See, Make in India is a structural effort. So it's about investing in our supply side, whether it is in our infrastructure or in our domestic production capabilities and so on. However, the point you are making is a much more cyclical issue, which is that domestic demand is doing well, but external demand is clearly shrinking, and it's nothing to do with India. You can look at China's exports and imports numbers, they've just crashed. And this has happened to every other country. Our own merchandise export numbers have also declined very significantly. So I think that is something that is not quite in our control. Now, yes, along with the exports declining, imports have also declined because the the prices of many commodities have come off. Now, I mean, sure, that's good from a current account stability perspective, but from a growth perspective, clearly exports is not really helping at this point in time. And as I have said repeatedly, the 6.5% to 7% growth rate that we currently have is a very good growth rate under the circumstances. Now, there are people who will say that, okay, we should push for even faster growth. Well, I would caution against doing that under the current circumstances where external demand is this weak. There will be a time when the highway is clearer, and that's when you should press the accelerator. Meanwhile, you should keep investing in our supply side, keep building domestic capabilities, build up our infrastructure, and so on. Because when the good times come, there is usually very little time to respond at that time. So you need to have built up our domestic capabilities for that time ahead of that point in the cycle. So, I mean, the main point I'm making is do not confuse short-term cyclical sort of deviations from what we need to do in the long term in the supply side.
Right, and I think my colleague Krishna is really keen on asking more questions about demand side, supply side, and more importantly on manufacturing. But before I pass on the mic to Krishna, I have a quick question, and this is on the basis of news that is building up on imports of items, electronic goods, PCs, laptops, palm tops, now cameras and printers. We've seen in the past couple of days, sirs, that there have been import restrictions on a variety of these items. Essentially, industry and industries in fact spoken to. I suppose the government has also asked government to perhaps push back these import restrictions, which could be harmful in the short run, could also see prices of, a lot of electronics item going up. I want to know your view on these import restrictions, sir, which seem to be now very frequent, but at the same time, there is a pushback that we are seeing even from government side, where the rollout is either imminent and then that's pushed back to 3 months from now. What is your view on the import restrictions that we are seeing now every second or fourth day on various other items, sir?
So, I mean, you can have these tactical kind of restrictions for short periods of time in order to support growth in a targeted area, particularly given the global situation, because you do want to build up maybe capabilities in certain areas. But yeah, I mean, I agree with those who say that this is not a long-term solution. You can give a one-time boost by doing this. Longer term, you will end up with the ambassador car problem. So, import restrictions and licensing work at best if it's targeted and for short periods of time. In the longer run, you have to have the capacity to compete in the rest of the world.
Right, Sanyal, the one thing I wanted to ask you is certainly, we are in an uncertain environment. We're seeing a slowdown in the markets, developed markets across the world, but India is steaming on with its ambitious targets to reach by the year 2030, and the consensus is always that it will be consumption driven. This Indian growth over the course of the decade will be consumption driven, and there are concerns over rural consumption and urban consumption both growing at a handsome pace. So I want you to help us understand what will be the challenges that India will have to overcome in achieving this consumption driven growth.
I will disagree with you. I don't think that we have a uniquely consumption driven model. Our model is, India is a moderately high investment country. We have a 30% of GDP is investment. We are dependent on exports, particularly services exports in recent years have done particularly well. So yes, having a large domestic market and domestic demand, both investment and consumption are important. But this idea that somehow we can grow by generating just domestic demand is not quite correct. We will need external demand, and we do need investment-driven growth as well. So I don't agree with this idea that some economists try to push that India has some unique consumption-driven model. It's not the case. You need to balance all these elements out: exports, investment, and consumption. And the very high periods of growth historically have always been driven by the consumption and exports, the exports and investment part of the equation, not by the consumption part of the equation. So consumption is a good baseline thing that provides certain amount of cushion maybe, and when things go a little difficult. But in the end, if you want high growth over long periods of time, it will be investment and export driven. So this is why I keep going back to the point that we should not attempt to use a demand-driven growth model in the longer run, because it runs out of juice very quickly, because your current account begins to generate very large deficits. Mm-hmm. So I keep coming back to the point is that just because there is currently an issue with external demand does not mean that we suddenly begin to invent a sort of new model for ourselves. There is no other new model. We just happen to have a good internal market right now, which is good, which gives us a cushion. But if you want 8% plus GDP growth rate, all the engines have to fire, which includes exports and investments. Right now, we have domestic investments are doing decently well. So is consumption. So good. We are getting 6.5%, 7% growth. But that extra kick is only going to come under circumstances where the global global demand is good. And trying to force it artificially using domestic demand is not a good idea.
Okay. So in the short run, Mr. Sanyal, while global demand is not looking too good at the moment, What, according to you, should be the growth drivers? What exactly is government focusing on? Because, as you rightly pointed out, until the road becomes clear, the pathway becomes clear, it's important for us to start investing. We've not seen a lot of investment come in from private sector. Would you agree with that analogy?
Not quite. So the fact that we are seeing 6.5 to 7% GDP growth rate at a time when clearly global drivers are not conducive is partly because domestic demand is actually decently good. And this is true for investment as well. So, of course, there's part of it is government-driven investment in infrastructure, but it is also true that you are seeing significant revival in private sector investment. This is true of real estate. This you are seeing in private investment. You're seeing an FDI also is doing decently well. So there is investment going on. So this idea that there is no private investment is, I don't quite agree with. There is a lot of revival of private investment, either already on the way or will shortly be there from what we can gather. There's also a lot of demand for services of all kinds. You will see the domestic PLI that you saw, all the measurements are red hot, well over 60. So reading over 50 usually suggests strong demand and orders in the PLI, the PMI, the monthly purchasing managers index. And our index is over 60, so which is red hot. So demand is good domestically. And I think that is good enough for a 6.5 to 7% GDP growth rate, which, as I said, is a very good growth rate under the circumstances. This should not in any way mean that we should take our eye off the macroeconomic stability indicators and try to artificially boost growth. You know, somewhere 6.5 to 7%, very good. Now, global cycles do turn. And when that cycle turns, we should be ready. And that requires us, of course, to, make sure our investment, our infrastructure, our ease of doing business, and all of these things are taken care of. So that as and when the circumstances turn, as they will at some point, we are in a position then to ramp up growth to over 8%, which I think for the very first time, our supply side is capable of sustaining over periods of time because our infrastructure is now radically better. Our banks have been cleaned up and our financial capabilities are radically better. So we can sustain those 8% GDP growth rates when the circumstances are right.
Right. If I were to ask you, going forward, what would be the big challenge? I'm going back to the oldest debate possible in a situation like this, which is inflation versus growth. We have growth targets, ambitious growth targets, which we can achieve over the course of the next 6 to 7 years. And then there is inflation that continues to pose challenges. We are in a pause of a rate hike cycle. So talk to us, in the way forward to 2030. How do you think this debate should ideally pan out between inflation versus growth?
So this will have to be the last question because I have to go to another meeting. But let me say that we are very clear about this and that's the point I've made even in the last 20 minutes, that we are macroeconomic conservatives. We will not sacrifice macroeconomic stability for a few percentage points here or there of growth. We showed that even during COVID, we maintained macroeconomic stability, did we not? So that's the point I'm making to you. We will maintain inflation in the 2 to 6% range. The Reserve Bank is clear about it. We are clear about it in the government. Let me say that continues to be the case.
All right, so stability over growth, that's the word coming in. Mr. Sanjeev Sanyal, thanks very much, sir, for taking time out this afternoon for speaking to TV9, News9 Plus in general. And we are, of course, celebrating 76 years of independence. The focus remains on growth that is organically driven as opposed to externally pushed. And of course, that's the big message coming in from Mr. Sanyal.
No, I think you misunderstood what I'm saying. I said it should be organically driven, and when the circumstances are right, externally driven. It should not be artificially demand managed. That's the point. Do not pump demand artificially. Keep the growth growing. 6.5 to 7% is a perfectly good growth rate. Artificially trying to pump it past that range when external situation is not good is not a great idea. The time for getting growth going at 8% will also come, but in those circumstances will be there. Our supply side is capable of doing it organically as well.
Okay. Okay, so no artificial tinkering, if that's the message I can take away from that conversation. Mr. Sanyal, thanks very much, sir, for taking time out this afternoon and for joining us on this discussion.
Thank you.